Did you know that keeping too much cash in your primary bank account doesn't just lose you money to inflation, it actually triggers automated flags with federal agencies? Most people think their entire balance is 100% protected, but the rules have changed and your bank is not going to send you a warning letter. If you have worked hard your whole life, it is time to stop letting your money sit idle and start protecting it before the system forces your hand. I am Dr. Collins, and for decades, I have navigated the labyrinth of federal benefits and institutional policies. Many of you trust that your bank is a fortress. You believe that your life savings kept in a standard checking or savings account are invisible to the prying eyes of government oversight. The reality is far more clinical. Modern digital banking operates on a backbone of sophisticated algorithms designed for surveillance, not just convenience. When you maintain large, static cash balances, you are inadvertently crossing a threshold that triggers internal reporting requirements. These are not human decisions. They are automated pulses sent directly into the bureaucratic machine. We often talk about privacy as if it is a default setting, but in the current digital landscape, privacy is something you must actively architect for yourself. The system is designed to keep you in the dark while silently documenting your every move. If you are sitting on a nest egg that is slowly being flagged by algorithms, you are already on the watch list. Do you know the exact threshold that triggers a formal report? Most of you believe that keeping your hard-earned savings in a standard checking account is the safest path. You trust the FDIC logo on the door, assuming your wealth is sitting there ready for whenever you need it. But here is a reality check that very few financial advisors will share with you. Inflation is working against your balance every single day. When you leave a significant amount of cash sitting in a low-interest checking account, you are effectively paying an invisible tax. As the cost of living climbs, the purchasing power of every dollar in that account quietly evaporates. You aren't losing the number on your screen, but you are absolutely losing the ability of that money to pay for your groceries, your medical bills, or your heating costs next year. The system is designed to keep you comfortable while your capital sits stagnant. Banks are more than happy to hold your liquidity, but they aren't obligated to protect its value against the rising tide of inflation. While you sleep, the real-world value of those savings shrinks. It is a slow, silent erosion of your financial independence, and it happens whether you notice it or not. If you think this is just a minor concern, you are miscalculating the impact of compounding inflation over a decade. But here is the critical turning point. What happens when a sudden health issue or home repair forces you to tap into these savings? You will discover that the money you worked 40 years to accumulate no longer stretches as far as you planned. Your bank is happy to hold your money while it loses value, but what happens when you finally need it to cover your cost of living? Many of you believe your life savings are bulletproof simply because of the FDIC logo on your bank's front door. You've been told that your wealth is shielded, a comfort that has allowed you to sleep soundly for decades. But as a former benefits advisor, I have to be the one to tell you that this sense of security is built on a dangerous misconception. The FDIC insurance limit of $250,000 per depositor per ownership category is not a blanket guarantee for your entire net worth. The reality is stark. If a regional bank faces a failure scenario, the federal government covers only up to that specific threshold. Anything sitting in your account above that amount is technically unsecured. You become what is known as a general creditor. When a bank collapses, those excess funds do not magically remain yours. They enter a legal process where you might only recover a fraction of what you lost, if anything at all. It is a harsh truth that many retirees discover far too late, often when the doors are already locked. We have seen this play out in recent years with mid-sized institutions. The system is efficient at protecting the standard depositor, but it is not designed to be a total safety net for those who have spent their lives accumulating significant reserves. If you have been parking your retirement nest egg in a single account, you are leaving yourself exposed to systemic risks you likely never considered. Would your life savings survive a regional bank collapse? You might be more exposed than you think. Keeping your entire net worth in a single checking account is like leaving your front door wide open during a storm. It defies logic, yet millions of retirees do it every single day, trusting that the system will automatically handle their financial survival. That is a dangerous gamble in today's volatile economy. As a retired benefits advisor, I have seen the panic when the unexpected happens. a sudden freeze, a technical glitch, or a regional bank collapse. You need a buffer. I call it the golden ratio. By keeping exactly 3 to 6 months of essential living expenses in your liquid checking account, you create a firebreak between your daily life and your long-term wealth. Think of it as your financial survival kit. If your debit card is compromised or your account is restricted for verification, you aren't scrambling for grocery money. You are secure, you are stable, you are still in control. This isn't about hoarding cash under a mattress, it is about strategic liquidity. It is about knowing that no matter what technical hiccup occurs at the bank level, your lights stay on, your mortgage is paid, and your peace of mind remains completely intact. But here is the hard truth. Keeping too much liquid cash in a non-interest-bearing account is its own kind of loss. Inflation is a silent tax that eats away at your purchasing power every single hour your money sits idle. Many people find themselves trapped in a cycle of fear, paralyzed by the idea of moving their money anywhere else. But if you think your bank is doing you a favor by holding that surplus for free, you have been misled by the system's silence. Now that you have your safety net, what do you do with the remaining surplus that is currently sitting idle? Stashing your surplus cash in a standard checking account isn't just a missed opportunity, it's a quiet retreat for your hard-earned wealth. While those funds sit stagnant, inflation slowly erodes their power. It is time to look beyond the local bank teller window and explore modern tools designed to work for you. First, consider high-yield savings accounts. These aren't like your typical neighborhood bank accounts. They often offer significantly higher interest rates, allowing your money to grow while remaining relatively liquid. They provide the safety of FDIC insurance, yet they don't demand your constant attention to maintain a competitive return. Next, look at Treasury bills. These are direct loans to the federal government. They are widely considered one of the safest investments in existence. When you purchase T-bills, you aren't just saving, you are essentially securing your principal against the volatility of the broader market. The interest earned is often exempt from state and local taxes, providing a cleaner path to retention. Then there are brokered CDs. Think of these as elevated certificates of deposit. By purchasing them through a brokerage rather than a single bank, you gain access to a wider array of terms and rates. You are essentially shopping the entire market to find the best home for your capital. These tools are not meant to confuse you. They are designed to offer you more control. By diversifying where you keep your wealth, you are building a sturdier financial fortress. Wait, did you know you can spread your money across multiple banks with just one single account setup? Many retirees are unaware that specialized platforms allow you to achieve comprehensive coverage without managing dozens of individual passwords or logins. Inflation is the silent thief, slowly eroding the purchasing power of your life savings while you keep your funds sitting in a standard, low-interest checking account. You worked decades for that nest egg. Watching its real value shrink every single year is a bitter pill to swallow. But you do not have to just sit there and let it happen. There are government-backed tools specifically engineered to fight back against rising costs. I am talking about Series 1 savings bonds. These are not your typical volatile stocks. They are designed by the Treasury to keep pace with inflation, directly protecting your hard-earned wealth from being whittled away by an ever-changing economy. When the cost of living climbs, the interest rate on your I-bonds adjusts accordingly. It is a fundamental shift in strategy from merely saving money to actively preserving your lifestyle. Alongside these, money market accounts offer a different kind of shield. They provide the liquidity you need while often yielding better returns than your local bank's basic savings account. You are moving from a position of financial passivity into one of calculated protection. It is about ensuring that the dollar you have today still buys you the same quality of life tomorrow. But here is where you need to be sharp. Many people dive into these tools without checking the fine print, only to find themselves hitting unexpected walls later. While these instruments are incredibly safe and effective, there are specific, strict buying limits you absolutely must understand before you decide to move your capital. If you try to jump in headfirst without knowing these federal caps, you will find your funds locked or returned, leaving you right back where you started. If you think you know the rules, you might be surprised by how quickly they can change. Are you ready to see exactly how these limits work? You have spent a lifetime building your nest egg, laboring through decades to ensure your retirement remains stable. Yet, the current reality of our banking landscape is shifting beneath your feet. It is not about fear, it is about absolute clarity. You hold the authority to protect every cent you have earned. Start your audit today. Pull your last 3 bank statements. Look for inconsistencies, unexpected service fees, or unauthorized withdrawals. Do not wait for a notification that may never arrive. Your financial sovereignty begins the moment you decide to scrutinize the digits on those pages yourself. If you notice a discrepancy, contact your institution immediately and request a formal review. You are the custodian of your own legacy. As Dr. Collins, I have seen too many individuals lose momentum because they assumed the system would look out for them. That is a dangerous gamble in today's automated financial environment. The banks prioritize efficiency, and algorithms often flag legitimate transactions as suspicious, locking your access without a moment's notice. You must be proactive. Update your contact information, establish a trusted contact on your accounts, and keep a digital or physical record of your major financial moves. Knowledge is the ultimate shield against systemic oversight. This journey of reclaiming your financial destiny is not a solo endeavor. By staying informed, you create a buffer for your future. The government will not call you to warn you about these risks. Are you ready to take charge, or will you let your bank decide your financial fate? Subscribe to this channel to stay ahead. Share this video with a friend who needs to hear this truth. This is not financial advice. It is your roadmap to security.